Wholesale prices took an unexpected dip in August, dropping by 0.1%, just as the Federal Reserve prepares to make a crucial interest rate decision this month. This surprising development could give the Fed some much-needed flexibility to consider cutting rates, according to a report released Wednesday by the Bureau of Labor Statistics. The Producer Price Index, PPI, which tracks the cost of inputs across a wide range of goods and services, fell by 0.1% in August. This was a notable reversal from July's revised 0.7% increase, and significantly below the Dow Jones forecast, which had predicted a 0.3% rise. Over the past year, the headline PPI still showed a 2.6% increase, reflecting ongoing inflationary pressures. Looking deeper, the core PPI, which excludes the often volatile food and energy sectors, also declined by 0.1%, defying expectations of a 0.3% increase. When excluding food, energy, and trade services, the PPI actually rose by 0.3% for the month and was up 2.8% compared to a year ago. Following the report, stock market futures climbed. This decline was largely driven by a 1.7% fall in trade services prices, with wholesale margins for machinery and vehicles plunging 3.9%. On the other hand, goods prices edged up slightly by 0.1%, with core goods prices rising 0.3%. Food costs at the wholesale level increased by 0.1%, while energy prices fell by 0.4%. Chris Rupke, chief economist at Food Bonds, summed it up. The inflation shock that everyone feared simply didn't materialize, and markets are rallying as producer-level inflation barely shows any signs of life. This suggests that tariffs aren't yet causing widespread price hikes across the board. There's almost nothing standing in the way of an interest rate cut now. Despite inflation, the Fed has held off on cutting rates this year, partly due to concerns about the impact of President Donald Trump's aggressive tariffs on U.S. imports. While tariffs historically haven't caused sustained inflation, the broad scope of Trump's trade policies has raised fears this time might be different. For example, tobacco products, which are affected by tariffs, saw a 2.3% price jump in August. Portfolio management costs, which contributed significantly to July's increase, rose 2% after a steep 5.8% climb the previous month. Trump himself has been vocal in urging the Fed to lower rates, arguing that tariffs won't drive inflation and that the economy needs cheaper borrowing costs to fuel growth and manage the rising national debt. Meanwhile, the Fed's concerns have shifted somewhat from inflation to the labor market. A recent BLS report revealed that the economy created nearly 1 million fewer jobs than initially reported in the year leading up to March 2025, raising alarms about the strength of the job market. This contrasts with the Fed's consistent description of the labor market as solid. Next week's Fed meeting will be pivotal, featuring not only a rate decision, but also an updated outlook on the economy and future interest rate paths. But here's where it gets controversial. With inflation cooling and employment data showing signs of weakness, should the Fed prioritize supporting growth with rate cuts, or remain cautious to avoid reigniting